Thank you very much for joining us. Such a pleasure to have with us Roshan Padamadan of the Luminaries Global Fund. Welcome.
Thank you for having me.
And of course, you are a global investor based out of Singapore. So the topic that we're going to discuss is actually how you think about the vast opportunity set that you have in front of you, and how do you think about position sizing and portfolio construction? Perhaps those are concepts that don't get as much attention as idea generation and talking about investment ideas, but managing a portfolio is quite critical to investment performance. So perhaps you could share with us just a little bit about being a global equity investor based out of Singapore. How do you look at the world?
Okay, great. So now people are not used to seeing global funds based out of Singapore. Somehow it seems more natural to have them based out of New York or London. But that's actually convention. That's where the big stores of wealth are. So it's more usual to see that. But from a practical perspective, I believe the center of gravity is shifting towards Asia. Most of the emerging markets in this part of the world. The incremental wealth creation is coming from this part of the world. Singapore is as good a place as any. I don't know if any of you regularly fly Singapore Airlines. It's one of the best airlines. So it's well connected. And there is another reason. If you look at it, if I had to pick a place from scratch, in the West, disclosures are very good. You can just read the 10Ks, the US, the annual reports in Western Europe and so on. You get very good information. The amount of family ownership or the promoter ownership, the promoter is the founder or the family, it's very small. In the US, the average is 2% in the public markets. In the UK, it's like 5%, I believe. In Asia, it's much higher. In India, it's like 40%. Seeing 30 to 50% is very common in much of emerging Asia. So here, the level of due diligence required is higher. So you need to kick more tires in Asia. So if you need to kick more tires in Asia, it's probably better to be based in Asia. I mean, it is an advantage in terms of your traveling time, perhaps. You can also pick up a lot more of the local nuances here. When a family stake is very large, you also do a little bit of personality analysis of the family and of the founder, because it's not just about what the board of directors will decide, but because of the significant influence of the family, you have to understand how do they think about this company. Is it a 10-year game for them? Is it a 30-year game? Or is it a 100-year game? There are families who think of it as their family 100-year wealth and so on. So they will have a very different attitude towards investing, the kind of capex they'll do, the kind of strategy they'll do. Just something to be aware of. So I'm actually very happy with choosing Singapore as a location. It's a location of choice for me. I've lived in about 5 different countries. So I'm very happy to be here.
And when we think about Asia, of course, there are many different countries. And of course, you are a global investor, so you'll consider non-Asia as well as your opportunity set. In terms of portfolio construction, thinking about sizing positions, comparing various equity investment opportunities across countries, how do you go about that intellectually? Give us a sense of the challenges, and how do you as an investor think about the process for doing that?
Okay. So now, very important thing is that different countries are at different stages of development. So inflation levels will be different, the regulatory structures will be different, etc. But just to compare expected returns, you have to make sure you are comparing the same currency. So that's the single most important thing. If a company offers you a 10% dividend yield in Vietnamese dong, should you take it? Is it a good dividend yield? You need an anchor. So you can look at the 10-year government bond yield of the Vietnamese government. So that will give you an anchor of what is the real rate or what is the bond yield. Then you look at inflation, then that will give you the real yield. Now you can adjust for all of these. So what I do is, for all the countries we invest in, I take the 10-year government bond yields. I make that as one reference point for the respective countries. Then I compare that. Then to that I add the cost of hedging that currency. So if it's a weak currency, I hedge it back to USD. So the important thing is you're trying to select a team. You want to select them, you want to give them a level playing field, then you can select the team. The team is the portfolio. The most important skill in investing, I believe, is portfolio construction. A lot of people have ideas. A lot of people have ideas all the time. If you speak to anybody in a shop, in a supermarket, they'll all have at least a couple of great ideas. I think this company is a no-brainer. You should buy X or Y. Everybody in Singapore has a view on Singapore property. Very fascinating conversations you can have. Now, on the topic of comparing it on the same level, so what I do is I look at the earnings yield of the company. I look at my expected earnings yield. I'll see if I agree with it or not. But even at a very basic level, for a screening level, I just take trailing earnings. Trailing avoids the contamination of analysts, because analysts can be optimistic or pessimistic. Analysts are very smart people, but they do go through sentiment swings. And when they cut or increase numbers, because sometimes they can increase estimates by 100% or they can cut it by 30%. I don't want that contaminating the comparison. So I always take trailing. Then I add the cost of hedging the currency back to USD. So if for an Indian stock, if the cost of a 1 year non-deliverable forward, let's take the cost of the FX cover, you're hedging it back to dollar. You're going with dollars, converting rupees, you want dollars back at the end of 1 year. The cost of that is about 8%. It varies a lot depending on the volatility of the rupee. It could go to 6 or 10. But that is one factor which is fluctuating, but you can also put that in the Excel sheet. So you take the actual cost of the forex hedge, but let's say it's 8%. So an Indian stock with a 10% earnings yield, I add to the hurdle, it has to do another 8% to compensate for the loss in currency. So it has to do 18% earnings yield to be comparable to a 10% earnings yield for a US stock at a PE of 10. That way I've adjusted for the risk between countries. For every company, I look at the equity risk premium. For equities, I add 5%. I use 5% because that's what's based on the most comprehensive research we have seen of late. Professors Marsh et al. From London Business School, Dimson et al. What they have seen is it's between 4 and 5% over the last 110 years across 17 countries. So I just take 5%. So if the 10-year bond yield is 3%, I need at least 3 plus 5, 8%. Then I add on the cost of the forex hedge. If the hedge is 8%, then it needs to give me 3 plus 5 plus 8. It needs to give me at least 16%. After I've done this, then I can compare everything in the same currency, which is US dollar. This is just a rough filter still, because you still need to use your macro awareness. If a company in Mexico and a company in Turkey come up the same level right now, we are now at the end of Feb 2014, you should be aware of Turkey's macro risks. Political situation might change. It is a current account deficit country. A lack of political institutions might have chaos for a short time perhaps. So the macro awareness should be there. You might decide for Turkey I will demand something more, but that is your judgment level. You do that afterwards, not in the screening level. So this is how I approach the initial screening. And then you can also decide to adjust for, after the screening, you might decide you might demand a higher earnings yield for cyclical companies, because cyclical companies, the earnings yield change over time. So you have to figure out, have you been able to isolate the sustainable earnings yield, or is it a peak or a trough valuation? Because of the trough valuation, the P is, you might actually have a loss for some commodity companies. And commodity companies at the peak of the cycle, the P might be very small, it might be only 5, but actually it will be the most expensive time to buy if you do a through the cycle analysis. So for cyclicals, think of using something like cyclically adjusted PE. So I look at that. I may not necessarily use it all the time. The judgment is you have to judge where it is in the cycle. You have to have a feel. You have to get it roughly right. You don't have to we are exactly in year 3.5 of a 5-year cycle. You have to know whether you're at the beginning or at the end, because you can't be sure. So there are too many variables affecting something like a cycle. For cyclical stocks, there's another way to adjust it. I adjust it also by limiting their weight in the portfolio. This leads on, different managers might approach it differently. This leads on to my portfolio construction. So I use 3 different buckets. So I size the buckets in a way. I have 70%, 70 to 100 is earmarked for really long term. My long term definition is 5 years to 10 years. What it means is I believe I can see ahead for this company's business, how it will develop with a 5 to 10 year horizon. I can probably do that for Coke, for example, a simple example. Then I limit cyclicals typically to the mid-terms bucket. I call the I call the long-term bucket, I call it the foundation bucket. The mid-term bucket, I call it value, for lack of a better word. I mean, everything is actually value investing. But I call it value because I see deep value, perhaps, or I see them as a fallen angel. Sometimes the usual candidates who make it there are blue chip cyclicals currently going through a bad patch, or a fallen angel just going through a bad patch. So I limit that to 0 to 25. So the 0 to 25 is important because I don't like cyclicals as much as I like the stability or the foundation stocks. So it can be 0 also, but I can go up to 25. So 25 is like a cap. So these could be, let's say, unloved steel companies right now, because I believe that when volume picks up, their profits might go up 5 times. The first time I saw that cycle 10 years back, I couldn't believe it that a company's profits could go up 5 times. But after seeing a couple of cycles, you know that they can go down 80% and they can go up 5 times. But it doesn't mean it's a bad business. You have to know that it's cyclical. So I limit them to a particular part of size of the portfolio because I don't want my overall portfolio to be very cyclical. I'm not trying to shoot the lights out. I have a particular... Actually, whenever you pool money from many people into one portfolio, the portfolio has only one risk return profile. So you have to try and match it to an average investor, or perhaps you make sure that it's communicated very well to the investor. So I'm trying to generate sensible returns with modest risk. I want to take only sensible bets. Capital preservation is key, but willing to take some high risk bets. So the high risk bets comes to the last part, which is I call it the edge portfolio. I mean, I believe I have an edge throughout, but this is the one where I'm counting on the edge. So it's 0 to 5. So if I have no great ideas, maybe there's no great short-term ideas, there's nothing there. By short-term, I use 0 to 2 years as my short-term. So I have 0 to 2 years, 5%. 2 to 5 years is the value or the medium-term bucket. And the big part is 70 to 100%, because I'm happy to be all in long-term. But if I see some good, strong return ideas in the short term, and they will give me more return for this year than the long-term ideas, because the long-term idea might be compounding at somewhere between 10 to 15%, but I see some idea which will give me 20% in the next 6 months. I want to give some to that, but that I can't count on that forever, because after 6 months that idea is gone. So my balance is more towards long-term, some towards medium-term, and some towards the shorter term. Now within these buckets, I let the ideas fight against each other. I've calibrated them all to USD. Now the long-term ideas, Coke will fight against Pepsi for the long-term bucket. Is Coke a better buy than Pepsi? Coke has a pure play beverage strategy. Your bottlers, I mean, I don't know if many people know this, but there are 13 different ways to invest in Coke. You don't just have to buy KO, New York. You could buy their bottlers. In some countries, the bottlers have broader franchise rights, and some they have less. So you could buy the listed companies in Mexico, there's Australia, there's one in London, there's one in Switzerland. There are a couple of bottlers in Japan, all trading at slightly different variations of book value, yield, and so on. Slightly different businesses depending on how their history evolved and so on and so forth. So it's endlessly fascinating. Now, so you can make the 13 Coke companies fight against each other. Which one should make it in? Currently, the bottler from Japan, one of them made it into my portfolio. I don't have the main brand in my portfolio at this point. Now, looking at the other ideas, now these are fighting in their respective buckets. It's a little bit like leagues. So you're the big league players fighting only against big league players. The small edge idea can't really compete in the big one, because it's only 0 to 5. I will typically size it only at 1 or 2%. It's very unlikely to be a 5% idea. It has to be a really strong idea. It has to be a no-brainer merger arbitrage to be a 5%. In the long-term bucket, because I have 70% to play with, there's a sizing where I could be bigger. Most positions are 1 to 5%, but here I might go with 5% as the more normal ticket. While in the value bucket, I might do 2-3%, because I want to have perhaps at least 10-12 ideas in the long-term bucket. So 10-12 is about 50-60%. Then some ideas might be sized higher. Occasionally I might go to 10%. I have adopted a rule from Warren Buffett, which is, he says that you should have a punch card with 20 holes, and you just use them 20 times. So I've kind of, this is not there in the prospectus officially, but I've kind of adopted that concept. I have told investors that I might go I might size it very large, but I'll do it very occasionally, very rarely. So you won't see me go to 20% in some stock 3 times in a year. Then you can call me out on it. But occasionally I'll use it, because the other one is the other saying which Buffett says, which, when it is raining gold, you don't reach out with a thimble, you reach out with a bucket, right? So really, really great ideas with a good risk return skew, very low downside but a lot of upside. They are very rare. So when they come, I want to be ready. I believe I have one right now, but I'm still, but I've sized it at 5% for now. I will do some more work, then I will just make doubly, triply sure, and then size it up further. I have a direct play on it 5%, I have an indirect play on it for 3%, so it's 8%. It's actually already the single largest idea in my portfolio. I don't have to go to 20 at this point. I mean, it's just an option for me to go. There is another equally good idea which is also at 8%, so I'm fine with that combination. The other way to look at a portfolio, I mean, if you forget all the buckets and everything, is, I mean, for an investor, say you're the coach. Everybody likes to be a football manager, right? So you're picking a football team. So different people have different roles. You have to figure out what their strengths are. The really maybe small, thin, really fast guy may be a good striker. Or maybe he's tall and he's fast, he's a good striker. Someone else might be a very good goalkeeper. And someone else who's very dependable and steady might be a good midfielder. He's got good coordination skills, etc. Now in a portfolio sense, my goalkeeper is perhaps cash. I'm always, not always, but let's say I keep 5 to 20% cash. The job of the goalkeeper is always to catch the ball. My job of cash is to help me during a downturn, because the only thing which will help in a downturn is cash. The only thing which will help for sure. With shorts, you have to be sure you got the right shorts, or you're able to time your beta short. If you're doing an alpha short, then it's of course all about stock picking again. So cash has its own value. I use cash to write puts and use it as the margin, and I'm able to, in my view, get 6 to 8% on blue chip, writing puts on blue chips. I've tried to figure out why I get so much, but I've realized that it's essentially because of a couple of anomalies in the option market. One is implied volatility almost always is higher than realized volatility. It's like when somebody sells insurance, they don't sell it at the actual risk, they sell it at slightly more because they want to be compensated for writing insurance. So writing stock insurance is one good way to start insurance. Otherwise, if you want to start a real insurance company, the capital requirements are enormous. I've thought about it, maybe later. Now the other part is put implied volatility is always higher than call implied volatility, which is an anomaly, because if it's a mature company, things are fine. There is no reason for it to be. I mean, if it's at a particular level for a short period of time, let's say 1 month, there is no drift element, let's say, the put and call implied volatility should be same. So people are always more afraid of the downside, so they pay up more. Or people who write insurance and puts demand more and they're able to get it. That's what we're seeing from the actual option prices. So because of these two reasons, puts are a good thing to write if you have the courage to do it, because you have to be very sure you've done the fundamental analysis and you're happy to get that stock put to you or assigned to you if you write the put. So on a very small handful of stocks, I'm quite happy to write puts. I can do it all across this bucket, even for edge idea, because sometimes the volatility can be quite high. It might be 60% implied volatility, but I think the stock is probably a 20% actual volatility stock. So if the vols are too high, I will sell vol. I'm getting paid a premium for it. If the stock gets assigned to me, it doesn't mean I'm wrong. It just, I've already got paid for the risk I took. So it's a fair trade. So for example, I've already written some puts, some stocks I got assigned. I'm happy with the stocks. Some I didn't get assigned. I collected the premium. I'm again happy. So this actually gave me the confidence that I can generate 6 to 8% without too much risk being taken. Just with blue chips, I can take it. The big thing to add to that, I mean, I'm aiming for 15 to 20%, just as an illustration. That big part is opportunistic stock picking, idea picking, security selection. That depends on whether the market gives me that opportunities. So like Joel Greenblatt would say, I'm looking for the spin-offs, mergers, acquisitions. Usually I see a lot of mistakes being made there because it's a little bit more complex than what can be written up in a quick newspaper report. You have to read the document and you have to do a little bit more than back of the envelope, perhaps. You don't need any calculus or something. It's just still high school math, but you just need to do a little bit more numbers to figure out who is paying what and what's happening. And we see a lot of other mistakes, which is, I mean, this is well pointed out by many other managers, but when you have a spin-off, nobody wants a $500 million company because it's too small for the big fund, so they sell it and then you have a depressed price. But if you've done your work, you can buy it and you can just hold it. So now, for me, I have to decide whether to buy. Is it a medium term? Is it a short-term aberration? I don't really like the sector, but I think it's deep value. Maybe I just want to hold it for 2-3 years, but I don't really believe that's a sector I want to be in for the long term. So it will go into my medium-term bucket. So it won't get sized more than a particular level. I mean, the whole bucket is 25%. But if it's a sector I really like, maybe it's a pharma company and the spin-off is very cheap, maybe it will go into my long-term portfolio. So whenever I buy a stock, I have to assign it to a book. I have to assign it. So at the time of buying, I already have compared with other ideas and I assign it to a book. I can change books if I change my mind, but essentially the idea is that I have thought about it. I've thought about the exit point. Actually, I read a 2-pager on everything I buy. I document why I bought it, at what price would I buy more and what price would I be happy to sell. The price, I try not to put a dollar amount because with inflation, everything will go up over time. Normal inflation, I'm not talking about any hyperinflation from QE, which is a different topic. But essentially, I put in a multiple or some other trigger point or catalyst. If this company is already at some particular level in the market, perhaps it is not worth staying in for longer, etc., etc. So these are not technical exit points. These are valuation exit points typically. More commonly, what I would expect to happen and what I do see happening is the other good ideas which keep coming, the other smart players on the bench, they come and challenge the tired players. So the manager says or the coach says, okay, you come on out, I'll send you in. So make sure I have a good bench. So I have about 30 companies in the portfolio. Think of it as a big football team. I have 300 people on the bench. It's a really long bench. Then I have about 3,000 people in the candidate list. These are all people who want to come in, but they're out there. So the candidates are screened out. I actively follow maybe 300. And then there are 30 who are actually playing. And it's important to keep watching your players. You don't change them every day. There's no point because there'll always be some random variation around your players' performance. You don't change them just because they missed a shot at goal. You have to see, is the performance really deteriorating? Are they getting tired? Did you miss something in your earlier analysis? This is where the documentation helps because one of the biggest things is, as neurologists have found, memory is actually like a fuzzy thing and your memory can fool you. So it's better to write it down. Why did you buy it? It's okay to write it down and it's best if you spot your own mistake because then you improve. So you always keep improving. So it is a journey and you keep going. There are some things actually investors can learn from chess grandmasters. In one sense, in chess it's actually very hard to use the same trap twice because once you have played a trap, for example, it's actually a matter of public record. It goes into the database. So your opponents, if they are preparing properly, they can see all your previous games and they can prepare and come in. Investing in some sense, the market's always moving. Things are different every time. Because it's no longer the old prime minister, it's no longer the same central banker, things are different, things are moving. So you have to keep learning. So you have to keep checking your players. Are they fit for the new environment? Maybe it is a different country, weather is too hot, maybe these players get too tired. This is kind of like a macro awareness. So you should be aware of macro. It again requires a lot of judgment to figure out how much to discount for macro. Like if the macro is very uncertain, will you avoid all cyclical stocks or will you go all staples? The key thing to remember is that covariance or correlation is just a number. It doesn't actually determine the real correlation between all your picks. There might be scenario concentration which might actually creep in. You might think you're in 10 different sectors, but if you have the same worldview for everything, which is, I think tapering will go from X to Y in 3 months. And let's say you bought the most leveraged bank, the most leveraged industrial company, everything with a view that, let's say in one particular country rates will be cut. If they're not cut, all your portfolio is actually having the same scenario concentration. So it might actually be more than 10, 20, which you might have kept as your sector bet, sector risk limit. So scenario concentration was something to worry about, which is why I like the football analogy of different people doing different things. So if things blow up, your job is to catch things, which is the goalie or the cash holding. While things are doing well, maybe the striker scores a lot of goals. But you keep the midfield. Just because things are going well, you don't put everybody in as a striker, right? No football team sends 5 strikers. It might you think it might score more goals, but we intuitively know that it doesn't, because your midfield is so weak that you will really suffer when the opposition attacks. And in the markets, you can be sure that the opposition will always attack. So you need some stability. Stability doesn't just mean buying very defensive low beta stocks. It could be many different things. You buy with a large margin of safety. That could be one form of stability. You might choose to have something quite low business risk, like big pharma. I mean, it depends on your view on big pharma, but essentially you can always do stock picking to decide where you want to be in the spectrum. So you have to balance this, and this is the biggest challenge. In many fund houses, what happens is the analysts get promoted to fund manager, but I think putting things together is a different skill set from analyzing deeply. They will also learn, but I think this training should also be part of moving to a fund manager, because I think there are 2 different jobs. The good analyst could also be a good fund manager, but it doesn't necessarily follow, because a good analyst skills are very different. You research deeply, you figure out all the connections and so on. It's just like being a good, to be Lionel Messi is very different from being Alex Ferguson or the coach or the manager of a football team. So that's how I see the 2 different things. I mean, there might be great people like Franz Beckenbauer who did everything, but the point is that it doesn't necessarily follow. So those are some considerations I would keep. Balance the portfolio across sectors, countries, risks. The risks need not just be mathematical factor risks and so on, but other scenario concentration. Watch out for that, because they can creep in. Because if you have a worldview, your worldview might affect everything. So you have to think about, what if I'm wrong? What if I'm slightly wrong, somewhat wrong? What will happen? You may not be able to balance for every particular scenario. That might be very hard, but because you have to take a view on, say there are 10 possible scenarios for the world, you might think scenarios A, C and E are the most probable, and I assign 30% probability, and this is what I'll build the portfolio for. For example, if you have an Armageddon view, maybe you should be 100% in gold, but that's a very low probability event, and if you build your portfolio that way, then you might be right only 1% of the time, because the probability is probably 1%, something like that. So you have to plan for the main scenarios and then kind of balance it. The other part, now we talked about the different portfolio selection part. The portfolio selection also, depending on the mandate. For our mandate, we are allowed to take any security in the corporate structure. That gives us another leeway to control the risk reward. So we think a company is great, but we think it's very cyclical. Maybe we don't want cyclicality. Maybe we could buy the bond of the company. Maybe it'll be the lower beta variant, because the bonds by definition won't fluctuate as much compared to the equity, because the equity is always the stub on top of everything, and so on. So you can actually calibrate the risk reward by choosing your place in the corporate structure: equity, preferred, or warrants in some countries. In South Korea, the preferreds are trading much cheaper than the common. It's an anomaly in the market. It's somewhat corrected, but it's still there. It didn't matter for long, because it didn't matter. But now that Korea is becoming more mature and dividends are more likely, people are lining up for the preferreds, because the preferreds have a dividend yield of about twice or thrice the common, and they're the same company. And by corporate law, they're actually less risky. So it's an anomaly. Sometimes it's just convention which leads something in a particular way. So if you're able to look through it, you can actually do good security selection to calibrate your risk return profile. I like exchange traded options. We don't use options for general leverage. We keep net exposure at less than 100. But we like options for calibrating the risk reward. So if you want to sell a deep, you can go in the money or out of the money, depending on how we want to approach the risk on that particular stock. So if I really like the stock and I would like to collect some time value, but I actually want to be assigned the stock, then I could actually sell an in the money put, because the probability of getting assigned is higher for me, and because I'll still collect the time value, and that's maybe that's a good way to get your 6 to 8% on a blue chip, and also get the stock, because I might want the stock because I like the dividend yield also. You can't get both at the same time, but you can collect the option premium, and then if you get the stock assigned, then you'll get a dividend yield from that point onwards. So these are some of the considerations I think about.
Well, Roshan, thank you so very much for sharing your thoughts on portfolio construction with us today.
Thank you so much.